Hi, this is James Zhang, and National Director of Old Capital. And I wanted to give you guys an update on what's going on in the multifamily space right now in terms of what we're seeing in the market, and then also what's going on with financing. So we're going to talk about market update up front, and then we'll get into Bridge, Fannie, Freddie, and then just overall strategy for a lot of deals right now and what we're seeing. So. My background, born and raised in Houston, Texas, went to school in Austin at UT, was an underwriter for 8 years at GE Capital. And then I've been focused on the lending side of multifamily for the last 6 years at Old Capital, and then have also invested in close to 30 properties across DFW, Austin, and San Antonio. And then, in the last 3 or 4 years, a lot of those deals have sold. And so I'm in about 18, 19 properties right now. All right. So in terms of market update, so everyone follows the news, but I thought I'd sort of take you back to where we, have come, right? So in terms of unemployment, in terms of jobs, I mean, peaked at 13% unemployment rate, and then now has been hovering around that 6% unemployment rate. Everywhere that I go, it seems like people are in need of workers. So I think if you want a job, you can go out and definitely get it. It's just whether or not those people have shifted into different things, right? So a lot of restaurants, a lot of hotels need, workers, but those people might have gone on to do something else, like construction or something else different. So it's going to take a little bit of time, I think, to figure out and get back to sort of where we were sort of pre-COVID, in that low 4 number, even high 3s on unemployment. Rent growth, I think we are finally starting to see some of the light here in the summer season for a lot of lease trade outs. And so on renewals, we had been seeing people be able to push rents, 2, 3, 4% on renewals just because people didn't want to leave during COVID. But the new person coming in the door is more difficult to get that, 3 or 4% rent bump year over year. In comparison, but now we are seeing that occupancies are super tight, especially in the B and C space. And so when you're at 95, 96% occupancy, people are able to push rents. Where we're not seeing a ton of rent growth right now is really the A space, just because the amount of new supply. And in collections, I'd say collections are still difficult, right? I mean, there's still some people who are staying in units, not paying, not applying for rent relief, and they're just staying. But I think as some of these eviction bans fade, it's going to become easier, and people are going to see when they read the news that you can't just stay in units and not pay rent. So I think as those eviction bans fade, and in Texas, we're starting to see landlords be able to evict tenants. And then, on the positive side, GDP growth, if you look at the bottom right here, Q3 was a big change, but then, Q4 and Q1 of this year, you're starting to see that positive momentum of GDP growth. And then, that is really spurring on capital, whether it's debt or equity. So on the debt side, we'll talk about bridge loans and the amount of debt coming into the market, but then also the equity. So the equity is sort of good in that it's easier for people to raise money. A lot of people are flush with cash right now, so it's easier to raise money. But the challenge is the demand for, let's say, multifamily product in sort of the Texas markets is super high. And so that's driving up pricing for these deals. And then, in terms of stimulus packages, I can't keep track of all of them, but in terms of just the amount of checks going out to people right now, the unemployment benefits are still above and beyond sort of what you typically get. And then, I think Biden's trying to push more infrastructure spending as well. And so, I mean, I didn't really notice it, but during COVID, but coming out of COVID, the amount of inflation that is coming right now, you didn't really see it in, your normal day-to-day life, but you're starting to see it now. And so whether it's gas, whether it's food, there's no doubt you're going to start seeing it in housing. And so you've seen it on the single family side, you've seen it on the pricing of multifamily sort of price per unit, but I think you're going to start seeing that in rents pretty soon in terms of just the inflation keeping up. So, all right, so I pulled some slides from Newmark's recent multifamily update from Q1, and they provide some great data, and so I wanted to share some of it with you guys. So sales volume, sort of Q1 2021 across multifamily was pretty much standard across the last 3 or 4 years, so about 35 billion in sales volume. What's interesting is, in Q2 of last year it was 15 billion. So there's a huge drop off in Q2. I don't think that's necessarily going to happen. I think it's going to be very similar to 2018, 2019. It's been a pretty steady stream of deals in 2021. And so I think we'll probably be up in that 2018, 2019 total volume for 2021 in terms of volume. In terms of market, I mean, I think this is what has shifted, is that some of the larger markets that you're seeing over, let's say 5 billion in transactions, it's not the majors, right? So San Francisco, you're not seeing a ton of money go or transacting in those markets right now. There's a ton of money coming into DFW. I think that's the #1 market in the last 12 months. Phoenix, Atlanta, and then Austin and Houston are getting a lion's share of the sales volume. In terms of cap rates, I mean, I think it's been down at least 25, 50 basis points from sort of pre-COVID. And, 10-year has come up to about 1.6, 1.7. So if you look at this gap, I guess you should just always make a note to yourself. If it's, more than 400 basis points, you should be buying everything. So, it's pretty scary to buy here in, right in the middle of COVID. But that's when, you could lock in rates at 2.5, high twos. And right now we're probably still in that range of, 3.5 on fixed rate products. So you're still about 300 basis points. Probably the one on this chart, I would probably look at the 2007, 2008 spread, cap rates at, let's say 5 and 10-year treasury at 4.5. And that spread was probably only 100 basis points back then. So I guess if you see this 10-year treasury run up to 375, that's where I would start being a little bit more hesitant on, how much or what I'm going to underwrite for my cap rate, right? And so what I expect to pay as well. And so you've seen this across markets, pretty much all of them, except maybe San Francisco, I guess, and Portland. Everybody else has compressed down, about 50 to 40 basis points. So, I mean, let's see, Austin is down about 20 basis points, Dallas about 30 basis points. So you're seeing cap rates compress everywhere across the markets. New supply, I mean, this is Houston, obviously is going to be a top one. Dallas, Atlanta. Atlanta looks like they're absorbing the supply relatively easily here in the last 12 months compared to the Texas market. So I think that new supply is always going to be a consistent theme. But I did read that it was going to be a little bit lighter, sort of 2022, 2023, just because COVID, nobody was putting the development deals together last year. So, 2 to 3 years out, it's going to be a little bit lighter. All right, so we always typically show this chart of, all the loan options you have as a multifamily investor, whether it's bank loans, whether it's Freddie Mac SBL on the smaller side. And then as you move into larger deals, you're seeing Freddie Mac conventional, you're seeing Fannie and non-recourse bridge. So we're going to sort of go backwards. We're going to talk about non-recourse bridge and then work our way through the rest of it. In terms of Fannie and Freddie, I wanted to show you this before we jump into bridge. Is Fannie and Freddie get about 70 billion each a year, so 140 billion. But you can see that Q1 was still pretty good, about 35 billion of the 140. But a lot of that was in Q1, and then in January, and then February and March were pretty light. And so I'm thinking that April and May are actually going to be pretty light too, because of what's going on in the bridge lending space. And so we're going to see them coming back here shortly in Q3 and Q4. All right, so let's jump into non-recourse bridge. So non-recourse bridge, to remind you, is really 5 million and above, flexible prepayment, 3-year typically initial term, and then 1% prepay. And this is for experienced sponsors. All right, so what's going on with bridge lending? So in 2018, 2019, there was no doubt a lot of bridge lenders in the market. Once COVID hit, they all disappeared, and it was very difficult to get a bridge loan. At the end of 2020, a couple bridge lenders started coming into the market. Q1 of this year, a lot of them poured back into the market very heavily, and then I feel like they're still coming into the market. So this is just an estimate, right? So I mean, we might have had 2 people quoting deals in Q3 of 2020, then we went to 7 or 8, and now there's probably too many people quoting bridge loans right now. So 10 to 15 bridge lenders in the market right now, depending on the deal. And so what that's done is it's really brought down all-in interest rates, right? So you really couldn't find a bridge loan post-COVID in April, but then it started, 4.5% all-in rate, and then it slipped to just under 4, and then now I would say probably 3.5 to 4% is where you're shaking out, depending if it's secondary market, if it's an A, B, or C deal. And then what sort of experience the sponsorship has is going to determine your interest rate. And so, these, non-recourse bridge lenders, they're going to price typically over LIBOR. It's going to be a floating rate. They really want to be 5 million or above. They really want to be above 10 million, just because these guys have a certain amount of capacity in their shops to work on deals. And so if they're doing all these small loans, it makes it difficult to get to, let's say, $1 billion. They're really going to look at your borrower experience, your rehab plan, sort of where you're going to take the property and how am I going to get out, right? Because the bridge lender has 3 years to get out of the deal. And so they need to see how you're going to raise rents, how you're going to improve the value, and then refinance me out. In terms of all-in rates, you really want to be above 5 million. Once you're above 5 million, you're in that 3.5 to 4% range. But then if you're under that, there's just not as many lenders. And so you're not going to find as many good non-recourse lenders, and the pricing is going to be higher. And you probably will look at a recourse bank loan if it's under 5 million a lot of times. All right, so this is really the dilemma that people have out there. There's probably 5 to 10 deals out there right now that are around this pricing, right? Let's say $30 million purchase price in DFW. And if you go to Fannie, you might get $21 million or 70% leverage. If you go to Freddie, you're at 19.5, which is maybe 65%. And then if you go to non-recourse bridge, you're at 24 million. So that's a huge swing. That's $3 or $4 million in equity that you don't have to raise if you're willing to take the risk of a non-recourse bridge loan. So, this is what has, probably maybe 25% of our volume in Q1 was in bridge loans, and then it might shift to over 50% in Q2 across Old Capital. So, a lot of bridge loans are happening right now. So I wanted to go through sort of what we're seeing in the bridge lending space a little bit more, but this just gives you a high level of why people are going to non-recourse bridge right now in terms of leverage, in terms of pricing as well. So in the past, the bridge loans would have been, 4.5%, 5% on interest rate in comparison, but now they've come, they've come all the way down to 3.25 or 3.5 on a floating rate basis, which is almost lower than Fannie. It's not quite lower than Freddie yet, but it's lower than Fannie on a lot of these sort of all-in rates at the very beginning. So, all right. So when people say, all right, I want a non-recourse bridge, what does that mean? Well, usually when we're looking at Fannie and Freddie, we're looking typically at a T12 rent roll OM that usually starts the process. We size it based on a 125 cover. But for a bridge loan, you're going to need a little bit more detail on your CapEx plan. You'll need your pro forma cash flows. So usually Fannie and Freddie, we look at 1 year pro forma cash flow. On a bridge loan, we're going to be looking at not only year 1, but year 2 and year 3 to see sort of where you're going to take the NOI. And so once we figure that out, we can figure out what the exit plan is for the lender. They're really going to look at the track record of the sponsor and have you done this before? Have you bought a deal, fixed it, rehabbed it, and then improved the rents, and then either refied or sold the deal? They're really going to look at rents by floor plan, and then also sell comps to support your purchase price. So, on Fannie and Freddie, a lot of times you're looking at leverage, you're looking at interest rate, and maybe prepayment penalty. On bridge loans, there's a little bit more nuances in terms of when you're deciding on a bridge loan, right? So there's the initial fund, there's the CapEx funding, how that's going to be drawn down. There might be an interest rate cap. There's going to be origination fees to the lender, to the mortgage broker. And then there's also going to be your prepayment is going to be based typically either on a 1% exit, and then there's probably going to be some sort of minimum in there in terms of minimum interest. And then you're also going to look at extensions and what those costs are and the conditions, and then also a lockbox. So lockbox is basically cash management. So they're going to set up a soft lockbox. Typically, money's going to go into that lockbox, and then if you do not hit certain hurdles, the lender is going to take control of that lockbox. So bridge lenders are going to have different types of language around that, and then the last couple of things you want to look at is net worth and liquidity could be different and negotiable, and then also how much equity guarantors are going to put into the deal. So those are some of the items that you need to review and understand. And this is what is, as a mortgage broker, all these things are negotiable with a bridge lender. And so our job is to really help you understand all the different options out there, because the number of bridge lenders is increasing, number of options are increasing, and so it makes it actually, pretty difficult to know all the bridge lenders out there and all the options that you have when you're looking at a bridge loan. So, all right. So when we're talking about bridge loans, they have really come in and taken a lot of the market, and so Freddie and Fannie are going to sit there and they took it for a little bit, but they're not going to take it for long. So Freddie Mac, let's just go through these. So, Freddie Mac conventional, 7.5 million and over, and it's priced over SOFR. I would say if you look at pricing, so at the beginning of the year, their spreads were over 300 basis points. They've come in, the spreads now are probably 260 to 265, maybe 270, just depending on the affordability and the quality of the sponsorship. So you're seeing rates in like the 270 range, 260 range on these Freddie floaters, which is fabulous. I mean, SOFR is only 1 basis point, so you're getting a great starting rate. The one thing that has changed from last sort of end of last quarter or third and fourth quarter last year was really because of the inflation that we talked about, the pricing of interest rate caps have come up, right? So if you, on a Freddie floater, you have to buy a 3-year cap. And so what that means is that you have to pretty much go out and buy an interest rate cap. And let's say you cap it at 1%. I just use 1% example. You can cap it at 1.5%, 2%, whatever you feel comfortable at. But we were forecasting LIBOR to get to 1% in 2028. And now we're forecasting it, or the Fed is forecasting it to come, in at, 2024. So that's a big difference, especially when you're buying a 3-year LIBOR cap. So it's become more expensive. So here's just an example on a $25 million 3-year cap, 1% strike. 3 months ago, it was probably 32,000. Now it's 135,000. So it's come up 3 or 4 times what it was before. Here's a deal that we closed in DeSoto. Similar, we talked about, 291 plus SOFR. So, 292 starting rate, and then that has come down, right? So 10-year term, 4 years IO, and with 1% prepay. So I mean, this is one of my favorite loans if you can get the leverage, right? So on this deal, the cash flow was good, so I was able to get the leverage. But, depending on where the pricing goes on a deal, if you can't get 65 or 70%, it might be difficult to use this loan on the non-recourse Freddie. And if you don't have experience, you're not going to get a Freddie loan. So it's going to be for an experienced borrower. Reserves. So on Freddie SBL, which are the smaller loans, 1 to 6 million, they're still sticking with the 12 months P&I. But on Freddie conventional, Their standard right now is probably this 6 months right here down at the bottom, 6 months of interest only. But we've seen that waive for good sponsors. So, go in and ask for that waiver if you can. And, I think they're going to start being more competitive, right? So Freddie can do a couple things, right? So they can change the leverage, they can change the interest rate, and they can get these reserves off. Because if they're trying to get to 70 billion and the bridge lenders are taking up all the, taking up all the deals, they're going to start being more aggressive. All right, let's go over to Fannie Mae. So Fannie Mae is more of a fixed rate product. They go $1 million all the way up. We're seeing a lot of people take flexible prepay on these. So 10/7s, so 10-year fixed, 7-year yield maintenance, or 10-year fixed step down prepayment request. Rates on these, because the 10-year treasury has run up from 0.7 all the way to 1.7, like we showed on the chart earlier, the interest rates on Fannie have come up, right? Because they pretty much mirror 10-year treasury, but they have compressed spreads in the last couple of months. So we're seeing 3.5 to 375 on rates right now. This was a recent deal that we closed. They wanted a fixed rate product. And so we went with, we got 10-year, 5-year IO, 30-year AM, and we did a 10/7. So this was a 224 unit deal in Irving that we recently closed. In terms of reserves, Fannie Mae conventional, their standard is 12 months P&I, 18 months P&I on 6 million and below. The big change I would say probably on Fannie recently is really that they are doing reserves just on your supplemental. So if you do an assumption supplemental, they are only doing reserves on the supplemental piece compared to they were doing it on the whole stack before. So that's a big change. So if you're looking at deals with the assumption supplemental, I would say, reach out to us and we can help you figure that part out. But supplemental part is usually a lot smaller, so it makes more sense to do supplementals right now. But we are seeing waivers down to 6 months interest only on the acquisitions. And so, but senior and student loans are not eligible. So just your conventional. Here's some recent deals that we've closed. Villa Gardens was a Fannie Mae refi, Courtyards was a Fannie Mae, Heritage Square was a Freddie Mac SBL loan. And then some of these other ones were Freddie, Fannie, Bridge across DFW. So, Old Capital is a mortgage broker. And so we finance all types of deals. And I think that's why it's even more important to know a mortgage broker right now, is because when Fannie and Freddie are not as competitive and you need someone to go out and search for, whether it's bridge or CMBS or HUD or construction loans, we can sort of help you do that, right? So we're sort of a one-stop shop across all of it and can help you throughout the entire process, whether it's before the deal, during the deal, after the deal. And we charge 1% of the loan at close, just like everybody else. So in terms of next steps, if you need help with a deal right now, whether it's a term sheet or just to review the deal, send me the T12 rent roll OM, or if you're looking at investing in deal and want just my commentary on it, happy to look over any investment package that you have. And then really, if you're just getting started and you want to set up time to talk, the best way is to email me and I can send you just a personal financial statement template and you can fill that out and we can go through it. Or you can text me your email. Here's my phone number. You can text me there at 214-300-5035. All right, great. Thanks, guys.